Hi, Andrew Bell here, and coming to you from the Gold Coast, which is enjoying the most beautiful of weather, and that's continued right from the start of this year. Now, a couple of updates before we move on to the fifth and final fundamental that we're reviewing out of this year's annual property report. The first is a little straw poll on the health of the Gold Coast at present. The week before last, our office was thrilled to have organised 800 people to attend a farewell lunch for the Queensland Commonwealth Games athletes, who are all starting to head off to Europe in preparation for the Glasgow Games in 90 odd days. Premier Campbell Newman was our guest and handed over a cheque for $440,000. We raised an additional $100,000 through the day's fundraising activities. The attendees were from the Gold Coast's leading businesses. It was amazing to hear how many reported that March was either the best trading month in their company's complete history, or most definitely the best since 2007. It was across all sectors of Gold Coast business, and so that was a really strong, incredibly strong statement. This supports the official figures showing that the Australian economy grew by 0.8% over the December quarter, which was up approximately a third of the previous quarter's growth of 0.6%, which you see on the graph here. As I reported in the last Enewsletter, the Reserve Bank Governor is increasingly optimistic about the Australian economy, but it's early days in the recovery, and it does come with a degree of caution. You'll see here the headlines in just one of our newspapers. You might remember just recently I talked about how important it was to see the trend in unemployment. There was a surprise tick up in employment in the last figures, and we wanted to see what the next month's figures would show. Well, the latest news on the job front, released last week, was very pleasing, with an increase in employment numbers by 18,100, resulting in a fall in unemployment to just 5.8%, which is of course completely against the forecast. All of this positive news, together with a surge in construction of new homes, which has been a key piece of economic activity that the Reserve Bank has been working towards, has seen the Australian dollar back up around the 94 cents over the past week. So the forward-looking indicators are certainly improving, and the reality is today we are still dealing with issues such as a reasonably high unemployment level, diminishing benefits from the very important mining sector, and what we continue to see as a transition into the new phase of economy, which is pretty tricky to manage. So now let's have a look at the fifth fundamental, being housing affordability. Now, the affordability indexes measure the extent to which the average weekly earnings can repay a mortgage from a medium-priced dwelling. It's calculated on the prevailing mortgage rates, average weekly earnings, and the medium home prices. Affordability at the beginning of this year was up 15% on the same time last year, the most favourable result in over 11 years. In fact, affordability has improved 43% since the low point of 2010. On the screen now is the latest HIA CBA affordability report, showing that the trend lines in affordability is certainly improving. The headline finding is that the housing cost as a proportion of gross household income has remained broadly unchanged since 2003 and 4, and that approximately was 14% of gross earnings. Now, just 14% of household earnings, the average homeowner with a mortgage has a substantial buffer before they suffer mortgage stress. The old rule of thumb measure was that households dedicating more than 30% of gross income were in distress. The latest figures say that over 80% of Australians pay less than 30% of their income for housing. However, the reality is that the current improvement in housing affordability doesn't actually represent a structural shift in Australia's affordability, rather the dominant impact of cyclical changes in lending rates, and to a lesser degree, low prices that came about from the fall in property values during the global financial crisis. Moving forward, we're seeing that real estate prices are rising, so they'll start to reverse the improvements in affordability. And when interest rates rise, they'll also flow through and have an impact on housing affordability. Now, reports out over the last week or so have shown that with price growth in cities such as Sydney and Perth, it's driven our national average of house price to incomes to near historic levels, rising to 4.4 times disposable household income. The last peak was during 2006 and again in June 2007, when the ratio was 4.5. You can certainly see how Sydney is impacting so heavily, not only on all of the national figures, but also on the Reserve Bank's thinking. We sure would love to see that particular market start to cool. So in summary, housing affordability is still very good, and it does remind us, for anyone thinking of buying, that you really should make your move now. There is no question that prices here on the Gold Coast still have price growth in the market, and we won't be seeing interest rates any lower than they are now. Both of those opportunities should be seized upon. There is no doubt that by year's end that combination will have changed. Well, that's it for this week. Wishing you all the very best for Easter, and I'm guessing so many will be taking the 3 working days between our double long weekend off. So next week will be a very, very busy week with visitor numbers bound to be up at very high levels here on the Gold Coast, and it'll be a strong 10 selling days. I'll be back to see you in a fortnight's time and share further research on Australia and most importantly the Gold Coast property markets. Regards for now.